All right, let's start. Good afternoon, everybody. I'm Miranda Mizzle at Tab Group, and I will be moderating this panel this afternoon. Let me just introduce the panel, and then I'm going to ask them to, in 30 seconds or less, just introduce themselves as well. On my immediate left, we have Juan Nieto, founding partner of Index Intelligence. To his left, Rafael Molinero, CEO of Molinero Capital. And to his left, Lance Smith, CEO of Imagine Software Management. And given that we're going to be talking about risk, which encapsulates an awful lot of the process, I'm going to ask each one of our panelists just to very quickly say, where you fit in the environment, what you do.
Okay. Thank you, Miranda. Please let me know if you can hear us well, because I know there's a lot of noise. Get closer to the microphone if need be. Index Intelligence is a hedge fund. It's a global micro fund, so we trade, although it's mostly dollar denominated, we trade everywhere in the world, every sector, in theory, every asset, although many times we're not in every asset class, mostly equities is the core of the portfolio, but it does enable us to see from a macro point of view what happens in the world and make this type of decisions influenced, as you may imagine, by events like Japan and the Middle East and all that. So it is, and I'll talk to you a little bit about the risk that is involved in, when people put emphasis into models and they think that they can account for all these types of situations and events. And my belief is that you cannot, but we'll see.
Thank you.
Just to introduce, we're a quantitative hedge fund, so CTA, trading all markets, futures and FX, but all across the world, same thing pretty much on the equities, commodities, currencies and bonds, and all our methods are based on mathematical models, coming from pure math concepts, physics, it could be biology or psychology, turning to mathematical models. And we will talk about the risk and the various sides of the risk.
And I'm Lance Smith, CEO of Imagine Software. So I don't come from a trading desk, but we service over 150 hedge funds around the world, and I'd like to share with you some of their experiences, how they would respond to these questions. We provide real-time portfolio management and risk management globally.
Thank you very much, gentlemen. There are obviously an enormous amount of areas that we could cover when we just look at risk. So we're just going to delve into some of these that the panel thinks are pretty important. So let me ask a fairly general question. I'm going to start with you, Juan Carlos, about where for you, what is the focus of your area of risk? Where do you think where is your biggest exposure and what worries you most?
I think what is interesting is, we were just talking about this right before we started the panel, is there is the efficient market theory that it's the main theory that you ask economists that rules the market. And what the theory basically says is that all information disseminates well and properly in the marketplace, and hence the markets are efficient. So you can model basically against this efficient market theory, and you can trade against that. But I would say that that gives you a full sense of security. I would say that if you think of the oldest profession, and I know what you're thinking, is not the one that you're thinking. Economists were there before. God created the universe from chaos, but you needed economists to create chaos in the first place. The interesting thing about the efficient market theory, again, is that it gives you the sense of you can model for anything. And if you model well, you'll be able to account for these things. But when you look at the results, most funds, especially in 2008, and even the last 3 months, or when the markets actually go down, you see that it's absolutely not true. So there's also a big debate between passive investment, following the indices. You cannot outperform the indices. 90% of the funds, 90, are not able to match the returns of the indices. So that is a big plus for whoever says that passive investment against active investment. I'll come back to this. I'll give you examples of why I think, things like the flash crash, for instance, disrupt this type of theory, and why that creates risk, throughout the marketplace. But the most important thing, I would say, Miranda, which is, it may sound like a very simplistic thing, but it's actually very important, is the idea that people feel they're protected as long as they have models. And I don't think that is the truth. That's not the case at all.
Okay. Rafael, do you have anything to add to that?
So yeah, for us we use a lot of models, so actually this is interesting. And the risk is at various levels. You have trade generation, pretty much how you build your models, you do your trades and what you build behind it, and that's pretty much the core of your alpha and where you make money. You've got the risk management, portfolio level, trade level, all those things. Still, I would say pretty much a model-based type of approach, and where you usually try to analyze things in advance to backtesting, things like that. Then you go into the other kind of risk, which for me a second degree, but you still have to take into account execution, operational, compliance, and all those other risks. More risk of how do you make sure you get into the market and you do what you're supposed to do without too much price impact or slippage and things like that, so that the strategies you put in place are not too deteriorated.
And what do your clients worry about? And I'd be interested in your comment on the efficient market theory as well going forward.
Yeah, efficient market theory has implications of risk management too. I mean, a lot of the traditional measures you've heard of, like VAR, for example, hinge upon a distribution, a normal distributed, Gaussian bell-shaped curve distribution. That's straight out of efficient market theory. And as we all know, that doesn't really hold up. So from a risk management perspective, you have to augment your risk management to account for the markets not being efficient. And that's where, for example, stress testing comes into play, and that's a very critical part of our offering.
So how... Did you lose me? Thank you. So how efficient do you think the market really is? I mean, you're going to give examples, and is there a gap, and how do you manage that?
I think the market is actually very efficient, but I think that's a good thing. How could you make money? And that's what the efficient market theory, actually says. How could you make money if the market is perfectly efficient? And that is based on the idea that people are irrational. Well, I think we all understand, that we try to be rational, but we truly are not rational all the time, which is what would be required of the market to be able to behave in such a way. And there are many examples of this, but if you look at the flash crash, and I'll let Rafael and Lance talk about standard deviations and how far out it means that an event may occur. But basically, when they had modeled things like the flash crash, in terms of how likely that was to happen, here's a good bit of information for you. The likelihood of that happening was something like 1 in a billion. So you needed the market to have been going on for a billion years to actually that event to happen. Well, actually it did happen, and it happened in a process. On May of last year, you may recall, I think it was May 20th of last year, the Dow was trading, to give you an idea, it was trading at 10,500. And within the day, it went down 500 points, 5% up to 10,000. Within 5 minutes, it went down from 10,000 to 9,500 in 5 minutes. So the market was down 10% at that point. It recovered within 8 minutes to go to 10,200. So at the end of the day, this is what would have happened. Imagine you are a regular person that has invested properly with a conservative approach and have a stop loss that would prevent you from losing money beyond the point where you put that stop loss. Now, let's say that you had invested at exactly 10,000. You had a gain of 5% because the market was trading at 10,500. You were not willing to lose more than 1%, so you had your stop loss at 1% below 10,000, 9,900. Now the market goes and it takes away your profit and it hits your stop loss. But the moment it hits your stop loss, it's just running away. It's running away from you. And it gets executed 4% below your stop loss. So instead of you losing 1%, which was your initial condition in the market for the stop loss, you end up losing 4%. Now, that is to the conservative person. I can tell you that I personally bought things because I had bids that were way out of the market, 23% below the opening price that day. 23% below. And they came back all the way, in many instances, to be flat. So in other words, they gave me a gift. 23% low, and then it comes back to the price it was. And I could sell them with a 23% gain. Actually, when you look at a 23% gain, it's more if you account it from the moment you bought it. But that gives you an idea of these things that are not supposed to happen, but happen every single day, in some extent, and some things that will never happen, but still happen in the marketplace. It is not efficient, and it is not rational the way it should be. And people, again, have a false sense of security, thinking that they can account for these things always. Now, some people, and I think Rafael do a very good job at doing this, and perhaps a very good job at profiting from them as well, by modeling into them. But
okay, fair enough. Do you think we have a false sense of security? I mean, I realize that you made money out of the flash crash, and some people lost their shirts too. But do you think we have a false sense of security?
Well, I think the efficient market, the efficient hypothesis, I think a lot of people in the room probably would agree that it doesn't exist. If not, our industry probably wouldn't be there. Because the definition of it would be there is no arbitrage, there is no profit opportunity. The behavioral finance, which I think Juan Carlos is mentioning quite a bit, is actually reflected in markets, whether we see overestimation, overshooting, like the flash crash, trends, which are pure herding mentality type of behavior, other kind of behavior like that. For us, going to models is actually the way to systematize and actually take out the bias that most people have and code it in and actually benefit from this bias that people have and us, removing it. Flash crash is definitely one of those events that is kind of an earthquake. It's pretty unpredictable when it comes. It's a massive number of standard deviation. We go into the fat tails type of distributions in finance, which we definitely see. Kind of normal and then some gaps and then really fat tails. On those events, different type of models will benefit. Stop loss are definitely sometimes in trouble with those kind of events. Although if they're tight, they actually can protect you quite a bit. And then the other thing, for instance, for us, we have models that are intraday and can actually benefit from vol bursts. And for instance, on flash crash, we actually made money also in our case. But it is definitely, to be honest, you could have made or less money in this day, because to me it was such a high random event on both directions that at least from a model side, discretionary is different. From a model side, it's by definition an unpredictable point. You can't build models on that. So risk management is definitely important in those. But people that had wide stop losses, not monitored and things like that, those are the people that really were in trouble. So days like that, we'll see them, will happen. We saw some, last year we saw a lot of those in 2008. In 2008, we saw standard deviation multiples, to the roof. We had, between 3 times and 10 times on a regular basis, where those should happen, less than 1% of the time, even less. So definitely the efficiency is not there. The risk has to be built in. To us, the risk has to be built in your strategy and in your other processes.
Okay, thank you. So let's move a little to the tools of the trade, perhaps, in terms of how people manage their risk, the stress testing of portfolios, particularly in environments that are moving like that with fragmentation in the market. What are you seeing? What are you hearing? What's out there?
Right. So of course, as we see, their probabilistic models have their deficiencies. A 1 in a billion thing actually means it should never happen. And so what we know from experience is these kinds of multiple standard deviation events happen all the time. That's why we don't. Risk management proper risk management does not depend upon simple normal distribution assumptions. Put another way, when you have a steep loss, it's not because you're unlucky, right? Because something actually happened. And so that's the main purpose of stress test, is to play out somewhat improbable scenarios, but possible still plausible scenarios to see how you perform in such a situation. So what we're finding...
Wait.
Please go to the Qantas booth.
It's like being at an airport.
Thank you.
So what we're finding is, compared to like a year or 2 years ago, our traders are actually intraday now doing more stress tests. What used to be a big first thing in a day or an end of day thing is now they're doing intraday if there's been a significant turnover in our positions.
I've got actually a question for Lance, because I think stress test is... It's going to be an interesting panel.
Wait.
That's Alice Julian from Barclays Capital. Please come to the information point. Thank you.
So stress test is definitely one of those things you have to do for risk management, because most of the normal computation will only capture those normal days, and you need to do that. One of the big issues I've got with stress tests is, by definition, they're very discretionary. You have to find plausibles, but yet not. So, like the flash crash on some stocks, there is probably no one that went to the point. Accenture, I think, went to 1 cent. I don't think any person would have predicted that in a stress test.
Right.
Same time, if you do crazy scenarios like that, all portfolios will fail. So finding the middle ground.
Yeah, that's the thing. Hello? Hear me? That's one of the issues with stress testing is they're very subjective. You have to design them. Unlike the standard measure of VAR, the one good thing about it is it's not subjective, so it's always done the same way. So it's useful in that sense, because if it changes from one day to the next, something happened. So you have stress testing, you require a designer, and so you have to look at history, what's happened in the past. You don't rely upon correlations because what will happen under extreme scenarios, things are uncorrelated can suddenly become hugely correlated, like a flight to quality scenario. Something tanks, they run up by the dollar, buy gold, etc. Whereas the correlation may have been very low, under a stress situation it will be very high. So the best you can do, I think, is look at history and be very humble because you can't necessarily pick the next big thing to happen.
Do you, and I'm going to ask you, gentlemen, do you look at, do you manage your risk differently today than you did 2 years ago? And is it changing from what you can see going forwards? Either, please.
I started a little bit more in the past, more dependent on I guess, the models and things like that, a little bit more like what Rafael would do. But, as I was saying, I believe the human element, common sense and having some type of criteria has taken over, fortunately, I think, for me. And there, Rafael mentioned a couple of important things here and as well as Lance. One of the things that has happened, unfortunately, with the dissemination of information is that markets are becoming increasingly more correlated. And that is not necessarily a good thing. Yeah. There's no reason why, if one market moves, everything else in the world should move in the same direction. So that is actually a bad thing, not a good thing. And the other thing is the bias. And the bias that Rafael mentioned, sometimes is built into the marketplace. And sometimes it builds intrinsically in some ways that people don't even realize it. And I'll give you an example. Most of the funds where people invest are long-only funds. Let me rephrase that. A long-only fund is a fund that can only invest going up. When the market is going up, buy something to sell it later if it makes a better price eventually. When the markets go down, what do? It's almost as if you said to someone, invest with me, I will buy, when it's sunny outside. And you will say, well, but sometimes it rains, and sometimes it rains hard, and sometimes there is flooding, and sometimes there is massive flooding. And they will say, well, that's okay, we'll just wait. We'll wait, and then when it goes down and it gets sunny again, we buy a little more. Sure, unless it's 2008. When the market just goes down and down and down and down, and it keeps on raining and it gets on flooding, and what happens is these guys are chained down to their system. They can only buy it on a long-only strategy. So that is the prevailing theory, by the way, in the marketplace, and that means that most analysts pander to that type of fund, which means also that most people you hear talk about on the news and things like that also do the same thing. It used to be, not as much anymore, but it used to be that credit rating agencies and analysts always had a rosy picture. Always. Everything that was a bad news, was kind of put aside, and then they would come up with, oh, but it is an opportunity. Yes, the CEO was locked up for robbery, but you can still buy Enron even though it's down 30%. It's a good opportunity. That type of thing used to happen. So there's
like analyst risk.
Yes. But the problem is that for the regular person, that's what they hear. CNBC, CNN, or whatever it is. So, and here is something that provokes many of those people. As opposed to what you hear from institutions and governments, shorting should not only always be allowed, it should be offered to even the smallest investors. That is the only way you can protect them. If the market goes down, you should be able to make money while it goes down. Not just have to cross your arms and wait for the market to come back up.
Okay, you touched on a really interesting point, which is the correlation in the markets. Do you look at your portfolios differently now because of that tight correlation? Because one of the questions has to be is, how accurate do you really think the information you have, given that what is happening over there is going to be biting whatever you may have within less than a second, but it may not have hit it yet. So how do you view that?
I would say we definitely saw correlations increase in the past couple of years. I think in correlation and sometimes I would say even intraday volatility, and that has probably been with the ease of trading now in various platforms, various exchanges at the same time. While people before you had probably the commodities trader, the equity trader. Now it's pretty easy to trade global assets around the world. I think all this, and especially models or people like us, probably did create even more correlation in some of the markets. Correlation is definitely a problem because you benefit less from diversification, which means on an overall basis your risk return reward is actually going down. So our models will take that into account. Position sizing and other things will take that into account. When you do event risk or stress test, you can actually stress those correlations. I think the stress is needed less and less because we're seeing it almost on a continuous basis. But so the models will adapt on that, and I think this correlation is quite important. The intraday volatility is also quite important because it impacts stops, it impacts other kind of tradings, even opportunities if you use stop or limit orders. So, a flash crash, this is kind of something that probably wouldn't have been able to happen if the technology wasn't there. So there's a lot of new elements, and I think you have to take that into account. On the feasibility level, for instance, when you do a model, does it make sense? Can you do something? And can the markets trick you on that? And also taking some of those opportunities are actually opening up too. I mean, now we can do things we couldn't do before. So we can trade much faster, but you have to be careful about that. A lot of people, especially in this room, are saying, this is the holy grail. There are pros, but there are definitely also a lot of cons. So I think we're very conscious of this risk, and when we pay quite attention, and correlation is a big one, but you mentioned also the predictability. That's a whole different level too. Correlation is known to be a fairly unpredictable variable. In most portfolio allocation schemes, you do come to return, volatility, and correlation. Of those three, I would say volatility is probably the most stable and still not very stable, and then correlation are fairly unpredictable, and return is definitely unpredictable on a short-term basis. So,
thank you. Do you want to add something to that? I mean, I'm particularly interested in, you're in the risk management business. Risk is like surveillance. It could be endless, and what you actually want is 2 degrees away from separation. So what are your clients asking for, and how do you manage to contain that?
Right. So what we're seeing in some sense is almost a return to more like common sense risk management. So rather than depending upon correlations, I want to see, I'm a long short equity guy, I want to see my exposure by industry sector, by credit quality, by liquidity, so just coming down more like common sense measurements as opposed to, fancy correlation measurements.
Okay.
If I may, Miranda, I think what Lance just said is very important. Let's use some common sense, but let's remember, that common sense is the least common of all senses. Let me play a little bit of devil's advocate here again. You may say, well, people on CNBC and CNN, the pundits, the analysts, they'd be wrong, but certainly there's got to be people, that actually get it right, people that really know best. Well, let me give you another very interesting example. 2009, every year they do this, but take 2009, the Wall Street Journal polled the top 50, by their own count, the top 50 economists in the US. They asked him several questions, but the main question was where they thought the Treasury would be at the end of the year, and they took 10-year Treasury bonds for that. Now, along with the FX, the Treasury market in the US is the most efficient and most liquid market in the world. Now, you're talking about the top 50 economists. It's either down or up. Perhaps this stays where it is, but you almost have a 50% chance of getting the direction right, and then you know where it is. Out of 50 economists, seven got the direction of the move right. Not the magnitude, the direction. 43 got the direction wrong. Out of the 7, 2 got the first digit of the magnitude properly correct. So you have the top 50 economists in the world making a prediction where 4% of them got it almost right. And people trade on that. Now, we are rational, the market is efficient. It's up to you to believe it that way, but I would say use common sense when you look at it, when you look at these things, and you realize probably not. Now, the good thing, I would say, is that means, and this is a word that everybody uses, that we can produce alpha, which means we can produce excess return above what the market does, because the market does enable you to do that, because it's not what you would think homogeneous and efficient.
Okay. Before I ask another question, does anyone have any questions? Quiet crowd. Okay. All right. Let's move a second to the trading process, because we talked about the markets quite a bit. What areas of the actual trading and execution process do you concern about, whether it's systemic risk, execution, connectivity, price impact? Where is your greatest concern? How do you know the information is correct? How do you know you're getting everything you need from the market? Let me start with Peps.
So for us, we look a lot at execution risk, and literally more from a risk side than an alpha side. It's more to make sure that when we trade, we don't incur slippage to an extent that it's actually putting in danger the trading system we've built. So we want to make sure price impact is reduced, whether it's temporary or permanent. And then the price we get is really well within simulation ranges. So I mean, especially when you're a quant hedge fund, you're building your systems, you're backtesting them, you're inputting some slippage levels. Liquidity is definitely one of the parameters. I think now people are talking much more about liquidity, which was something no one was talking about 3 years ago, even though it was still important. But the price impact of a trade is quite important. So whether you trade it very, very fast or actually sometimes very, very slowly, your point is, am I getting the price I'm trying to get?
How do you manage I'm sorry, let me just ask another question there. How do you manage the liquidity given the fragmentation of the market?
So, I mean, for us, it's a little bit easier than, most like equity trader. Like Juan Carlos, we trade highly liquid. I mean, futures markets, treasuries are the most liquid. Equity indices on the futures side are amazingly liquid. So most of the markets, I would say, except maybe a couple commodities, are extremely, extremely liquid. So if you trade within 4 hours, usually, except if you're doing sizable, trades, your impact is quite minimal. And even if you have one, it's a temporary impact. When I say temporary impact, that means you make the price move a little bit, but pretty much market makers will make it go back. So you take the slippage, but you're not doing more than that. A couple other traders, massive hedge funds, or on the equity side, will have what we call permanent price impact. They will have not only slippage, they will create a permanent price distortion in the movement of the equities or of the underlying stuff. So for us, it's about trading either in smaller size or time-wise, we're cautious in what we do.
And high-frequency trading, does that impact?
So we don't do hyper high frequency trading. I mean,
no, but high frequency traders in the market.
High frequency traders, they're good in that they're actually providing some liquidity, so that's actually a good thing. They can also provide some some of the flash crash was also some of those models have a systematic risk of pretty much going snowball effects, which that's another danger. But in terms of that's why the regulation, if they go too hardcore and kill high frequency trader, that's a bad thing because most of them are acting as market maker. So it is good too. If this volume drops, my main problem with super high frequency trading is the fact that a lot of the liquidity that seems to be here is not there.
Right.
A lot of those are almost phantom trades. You have bid asks. When you get close to it, they pull out. A little bit less of an issue again in futures, but in equities, the ratio, what they call cancel to hit, is massive now. And it was definitely, we're talking something like 40-fold in 3-4 years.
Okay, thank you. Lance, you were going to say something?
Yes, in terms of liquidity, a lot of our equity clients, they will break up their positions into liquidity buckets. So they'll look at, say, average daily trading volume from the exchanges, say for 3 months, and then they'll say, okay, well, my positions are like 1 day or less, 2 days, 3 days, and they'll break it up. And that can be very useful, especially if you have some redemptions. Say you're long short, it's very useful to have, you want to, hopefully, without giving up the alpha, it's better off if you can have your long and short positions balanced out in each liquidity bucket, because you have to pull some stuff off if you want to go with the more liquid stuff first. Secondly, if there is a market event, that the more liquid stocks are likely to perform a little better than the less liquid stocks. So again, if you want to be more balanced on the way down, the liquidity buckets are a good idea.
Okay, let me stick with you a second, Lance. What's the next step? What's the next generation in making sure that risk management in all its glory is as tight as possible? What are clients asking for?
Well, our clients trade many different strategies. So they one thing they want is help in making sense out of all this. It's so easy to produce so many numbers that what do you do with all this information? And so they will do. We'll create for them, or they'll create for themselves different calculations that kind of summarize things. So for example, let's say you're an options trader, and of course you've got things broken down by underlyings. You can see your net delta, gamma, etc. But even so, they might have 10 options in one name, and so they'll look at give me a calculation that gives me my average implied vol that I'm long and that I'm short, just so I can make sense out of what I'm looking at. So that's one of the downsides of too much information, is you can't make sense out of it. So they're looking for calculations that help to distill information into digestible pieces.
Okay, same question to you. What do you want next? What would make your environment safer, better? What makes you more money?
I think in terms of execution risk and all that, the tools are out there, and the risks are clear, and there's something that you can deal with everywhere here. All the people around us right now are dealing with that. I don't think there's a major risk in there. I think they are accounted for in a way. Go back to the basics, and the basics may be things like diversification, the real strategy, and non-dependency on actual risk. Risk is important in the sense that enables you to reduce some movements, but you still have to have the right strategy and do the right thing to be able to make money. Portfolio rebalancing in many instances that people need to use, but an over-reliance on that, where you decide that you have a percentage of a particular stock that you want to keep. Let's say you have 10 stocks and 10% on each one of them. And if one goes up, you sell it a little bit, and the other one goes down, then you buy more to keep the level, well. And that seems to work. But the problem is, again, if you do that just automatically, which people tend to do, you could end up, and I will exaggerate here, but you could end up, having Apple and General Motors. And as Apple goes up, because you want to have $1 million worth of Apple, you have to sell it because it's more expensive. So you have less and less shares of Apple as it goes up, and what happens is you make less and less money of that move. But as General Motors goes down, you buy more and more and more because you need to have $1 million of General Motors. In the end, you end up having $1 million of General Motors, but probably 1 million shares because it goes down to cents. And Apple, you have nothing, and then you lose all your trading by using a tool without thinking of the consequences. So doing autonomously things, relying on tools without using your brain to decide what it is, I think is a big risk.
Yeah, the dispersion traders love the rebalancing thing because they're long the single stock options, short the index options, so they're making out on both ends, because you're artificially bidding up one stock and depressing the other, they win on both counts.
Okay. Rafael, anything to add? Give you the last word.
For us, the future is really all the research we're doing. I mean, the idea when you're a hedge fund is pretty much to think about all the other ideas other people are not thinking about or not implementing. So the research is going to be all the quant work we do, whether it's in trading models, portfolio allocation, risk measures that maybe don't suffer the same pitfall that the ones we see. Also, we're a little bit, one thing you benefit from when you're doing a lot of work on the systematic side or the model side is you have less of this issue of trying to aggregate risk to have a couple measurements that give you, a human brain will only grasp a couple measures. A computer will process much more, which has pros and cons. It's not, that's a whole entire discussion, but it's very interesting. So for us, it's really into looking into new ideas and new ways of looking into markets.
Okay, thank you. Does anyone have any questions before we wrap up? Anything you feel we didn't cover? Going once? Okay, well, please join me in thanking the panel.